The stock market is doing something witnessed only 3 times in 153 years. Here's what history says happens next. If you've been following Wall Street this year, you've probably noticed something unusual. The bulls are running wild. As of November 13th, the Dow Jones, S&P 500, and Nasdaq Composite have surged by 17%, 26%, and 28%, respectively, setting new record highs. It's not just a bull market, it's a spectacular one. What's behind this rise? There's a mix of factors: the hype around artificial intelligence, stock split excitement, and optimism surrounding President-elect Donald Trump's second term. All of this has pushed major indexes to uncharted territories. But wait, is this too good to be true? Historically, when the stock market is this hot, it's often a sign of looming trouble. In fact, something just happened that hasn't occurred since 1871, and it could be a major warning sign. 3 times in 153 years, the Shiller P, E metric. The key factor here is the Shiller P, E ratio, or CAPE ratio. A valuation metric that's only shown the same pattern 3 times in 153 years. Unlike the regular price-to-earnings, P/E ratio, which is useful but limited, especially for growth stocks. The Shiller P/E smooths out the impact of economic events and provides a clearer picture by looking at inflation-adjusted earnings over the past decade. Right now, the Shiller P/E ratio is signaling something the market has rarely seen. This metric has predicted market corrections or recessions in the past, and investors are taking notice. What happens next? So, what does history say will happen after such an event? While there's no guarantee, historically, these signals have often preceded corrections or periods of market stagnation. With the stock market looking so stretched, it might not be long before we see a downturn, despite all the optimism driving prices higher today. In the end, the current market surge may be a reminder: when something looks too good to be true, it often is, and this time, the data suggests we might be in for a reality check soon. Keep an eye on that Shiller P/E ratio. History is rarely wrong.